Price to earnings ratio, or PE ratio, is the ratio for valuing a company. It measures its current share price relative to its per share earnings, or EPS. The price to earnings ratio is also sometimes known as the price multiple or the earnings multiple. By the way, if you like this kind of content, please consider hitting the like button and subscribing. It will really help out my new channel and give me inspiration to create more content like this. Thank you. Here are a couple key ideas about the PE ratio. Number one, a high PE ratio could mean that a company's stock is overvalued, or investors are expecting high growth rates in the future. A low PE ratio could mean that a company is undervalued, or perhaps investors are expecting low growth in the future. Companies that have no earnings or that are losing money do not have a PE ratio, since there is nothing to put in the denominator. Two kinds of PE ratios there are forward and trailing PEs. Analysts and investors review a company's PE ratio when they determine if the share price accurately represents the projected earnings per share. The formula and calculation used for this process follows. The PE ratio equals just the market value per share over earnings per share. So we can look at an example here. Peter's Tech Company has a market value per share of $100. Peters had $1 million in net income and 200,000 shares outstanding. We have no dividends, preferred dividends to pay out as well. So, what is the PE ratio? First, we have to calculate the EPS, which is just the $1 million in net income divided by the shares outstanding, which equals 5. So the PE just equals the market value per share, which is 100, divided by the earnings per share, which is 5. So this comes out to 20. But what does this 20 mean? So basically it tells us that we're paying $20 for every $1 of earnings. EPS comes in two main varieties. First, we have the trailing price to earnings. Trailing price to earnings is a relative valuation multiple that is based on the last 12 months of actual earnings. It is calculated by taking the current stock price and dividing it by the trailing earnings per share for the last 12 months. It's the most popular PE metric because it's the most objective. It's based on real proven data, assuming the company reported earnings accurately. Some investors prefer to look at the trailing PE because they don't trust another individual's earnings estimates. But the trailing PE also has its share of shortcomings. Mainly, a company's past performance does not signal future behavior. Forward price to earnings. The forward PE ratio divides the current share price of a company by the estimated future or forward earnings per share. This is the company's best educated guess of what it expects to earn in the future. However, there are inherent problems with the forward PE metric. Namely, companies could underestimate earnings in order to beat the estimate PE when the next quarter's earnings are announced. Other companies may overstate the estimate and later adjust it going into their next earnings announcement. Furthermore, external analysts may also provide estimates, which may diverge from the company's estimates, creating confusion. Valuation from PE. The price to earnings ratio is one of the most widely used stock analysis tools used by investors for determining stock valuation. In addition to showing whether a company's stock price is overvalued or undervalued, the PE can reveal how a stock's valuation compares to its industry group or benchmark like the S&P 500 index. In essence, the price to earnings ratio indicates the dollar amount an investor can expect to invest in a company in order to receive $1 of that company's earnings. This is why the PE is sometimes referred to as a price multiple, because it shows how much investors are willing to pay per dollar of earnings. If the company was currently trading at a PE of 20, the interpretation is that an investor is willing to pay $20 per $1 of current earnings. In general, a high PE suggests that investors are expecting higher earnings growth in the future compared to companies with a lower PE. Let's look at Tesla forward PE, for example. It has a forward PE of 243. Now, this means that investors are hoping for immense growth in the future. Investing in high PE has done some people very well over the last year. A low PE can indicate that a company may currently be undervalued or that a company is doing exceptionally well relative to its trends. When a company has no earnings or is posting losses, in both cases PE will be expressed as not applicable. The price to earnings ratio can also be seen as a means of standardizing the value of $1 of earnings throughout the stock market. In theory, by taking the median of PE ratios over a period of several years, one could formulate something of a standardized PE ratio, which could then be seen as a benchmark and used to indicate whether or not a stock is worth buying. Absolute PE, the numerator of this ratio is usually the current stock price, divided by the trailing EPS, the estimated EPS for the next 12 months, or a mix of the trailing EPS of the last 2 quarters and the forward PE for the next 2 quarters. When distinguishing absolute PE from relative PE, it is important to remember that the absolute PE represents the PE of the current time period. For example, if the price of the stock today is $100 and the TTM earnings are $2 per share, the PE is 50. The relative PE compares the current absolute PE to a benchmark or range of past PEs over a relevant time period, such as the past 10 years. The relative PE shows what portion or percentage of the past PEs the current has reached. The relative PE usually compares the current value to the highest of the range, but investors might also compare the current to the bottom of the side of the range, measuring how close the current is to historic lows. The relative PE will have a value below 100% if the current PE is lower than the past value. If the relative PE measure is 100% or more, this tells investors that the current has reached or surpassed the past value. Limitations of using the PE ratio. Like any other fundamental ratio designed to inform investors on whether or not a stock is worth buying, the price to earnings ratio comes with a few important limitations that are important to take into account, as investors may often be led to believe that there is one single metric that will provide complete insight. One primary limitation of using PE ratios emerges when comparing PE ratios of different companies. Valuations and growth rates of companies may often vary widely between sectors due both to the differing ways companies earn money and to the differing timelines during which companies earn that money. As such, one should only use the PE ratio as a comparative tool when considering companies in the same sector. Comparing the PEs of a tech company and an oil company, for example, may lead one to believe that one is clearly the superior investment. Other PE considerations. Because a company's debt can affect both the price of shares and the company's earnings, leverage can skew PE ratios as well. For example, suppose there are two similar companies that differ primarily in the amount of debt they take on. The one with more debt will likely have a lower PE value than the one with less debt. If business is good, the one with more debt stands to see higher earnings because of the risks it has taken. Another important limitation of price-to-earnings ratios is one that lies within the formulating of the calculation itself. Accurate and unbiased presentations of PE ratios rely on accurate inputs of the market value of shares and of accurate earnings per share estimates. The market determines the prices of shares through its continuous auction. The prices are available from a wide variety of reliable sources. However, the source for earnings information is ultimately the companies themselves. This single source of data is more easily manipulated, so analysts and investors place trust in the company's officers to provide accurate information. If that trust is perceived to be broken, the stock will be considered more risky and therefore less valuable. This is Peter from Money and Investing. Thank you so much, guys, for watching my video. Let me know your comments and what you think below. To those who are still watching, you're amazing. If you like this content and would like more investing videos, please consider supporting me at my Patreon page below so I can get better content out there for everyone. Thank you all.